Hello, everyone, and thank you very much for joining us today. My name is Susanne Lindhardt. I'm the Investment Director on the Brown Advisory Global Leader Strategy, and I'm joined today by the two portfolio managers, the co-portfolio managers, Mick Dillon and Bertie Thompson, who have successfully managed the strategy for the last 10 years since its inception. In today's webinar, we would like to reflect on the journey so far. We would also like to discuss the current market environment in the context of a long-term investment horizon, and we would like to hear about Mick and Bertie's perspective on the next 10 years. I do have a couple of observations to kick us off. The Global Leader Strategy is a global, concentrated, bottom-up equity strategy with a long-term investment horizon. And I've heard both of you speak about the sources of alpha being, on one hand, time arbitrage, and on the other hand, the two processes for investment selection and capital allocation, all supported by the organizational structure of Brown Advisory. And I thought that last point is a good one to maybe start with. It reminded me a little bit about something the legendary former chief investment officer of Yale University, David Swensen, wrote about. He wrote about the following: small, focused, independent firms with excellent people provide the highest likelihood of identifying the contrarian path to excellent investment results. So here's my first question. Would you say that you recognize this description of a successful organizational structure in the way how you built the global equity team here at Brown Advisory? And if so, how has that team shaped the success of Global Leaders so far?
Yeah, I'll start on that one. Thanks, Suzanne. The first thing I'd say is that the team is everything, and the culture within the team is what drives all of the outcomes. And so I guess the short answer to your question is yes. And Bertie often talks about having a team within a team. And that's exactly how we operate within Brown. If we think about what was the original idea, it was that Brown had this incredible strength in the US and history of investing in the US, but we had clients who were wanting us to bring that, but deliver it in a global context, and to solve a different problem for our now customers. And so if Bertie and I, when we often talk about this, our goal is very simply investment excellence. That is the goal. The mission is go and deliver double-digit IRRs. That's in absolute terms. And we like stretch goals. We definitely aim high. But having high standards is, back to your question, it's part of the team and the culture and the setup. And this is really, really fundamental to what we do. We think about culture a lot in terms of even just how we structure not just our day-to-day, but over the whole course of a year. And part of it comes back to being a partnership, a private partnership. And that equity ownership, whereby everybody who works at Brown is a shareholder in Brown. And then specifically for us, everybody who works on Global Leaders is invested in Global Leaders. And Bertie and I have incredibly high alignment, which I'm sure we'll get to in a second. So I think if you've got that right setup, it enables you, frankly, to do part of what we do, which is think really, really long term, because you know that you'll be there to deliver for the clients in the long term. And look, Bertie and I have been on an incredible journey. We're very lucky to be at Brown, and we're very grateful for the opportunity here to go out and do what we think can be really meaningful for our customers. And actually, Bertie wrote a letter on this. Bertie, I might hand over to you. Bertie wrote a letter on this about alignment and institutional alpha.
Yeah, thanks, Mick, and thanks everyone for dialing in. So in addition to Global Leaders, we also run a highly concentrated strategy called Global Focus. And one question we get frequently when talking to potential partners of that strategy is, this all sounds great, but why the hell are you at Brown Advisory? And we wrote this paper called The Alignment in the Sand. We do very strongly believe that working at Brown gives us significant organizational alpha, because, sort of building on the quote from Swensen, we are a small, focused team driving towards common shared goals of investment excellence. But at the same time, we have huge support from the partnership. So as you touch on, Mick, we are essentially a partnership within a partnership. And I think one of the biggest challenges that every investor faces, actually everyone on this call faces, is focus. How do you manage your time? Because return on time spent is a challenge that we all face. There are only so many hours in the day. Brown Advisory has been, incredibly respectful of our time. So we spend at least 90% of our time focusing on investing. And if Mick and I had our own business, we had a startup, or we worked for a much larger organization, our time would be increasingly diverted towards non-investment related activities. So I think having that superior focus is a big source of our organizational alpha. The second area I think that we're lucky enough to leverage the benefit of Brown is that we have been given every resource that need to be successful from the start. So we have 5 dedicated analysts in London. We work with a team in North America. Maybe we'll get into that when we think about stock selection or investment selection. But that's been a huge strength as well. Investing is very competitive. Most fund managers underperform, and if you don't have the resource that you need to be successful, that means that you're already at a disadvantage. And we'll probably talk about it later. But one of those very impactful resources has been the use of the behavioral coach that we've used since the inception of the strategy. We think we can get better as investors, and that's one very powerful resource that we've deployed. And I guess another huge benefit of working at the firm as well is the culture is very low ego, high humility. Investing is all about continuing to improve and get better every year, year in, year out, and ask yourselves how you can improve and get better. And that sort of very humble but continuous improvement mindset is something that it runs throughout the organization. So 10 years in, I'm and I know you are too, Mick, completely blessed to be working at this firm. I do think it gives us a level of organizational alpha that you wouldn't get in other organizations.
Great. Thank you very much. I'd like to spend some time now on the investments philosophy of global leaders. So you're looking for 30 to 40 companies that do something exceptional for their customers, which in turn drives profitability and ultimately should drive shareholder returns. Can you speak a little bit about the development of this philosophy and how it is implemented today? Yeah.
Beg your pardon.
Good to hear you.
I'll start on that one. Sorry. Look, Bertie and I are very much thinking about this from first principles. And we often talk about this. The most important person in any business is the customer. You need to solve a problem or create value for your customer. And if you do that, everything else will follow. And that's how we think about Brown, but it's how we think about investing as well, in terms of our job is to solve problems for our clients by delivering excess alpha. And so in fact, actually, when I think about it, 10 years ago, when Bertie and I first met, or just over 10 years ago now, this is one of the things that we immediately hit it off about, is sitting there and thinking from first principles about how does an investment work over time, long periods of time. And the answer is, if you create a ton of value for your customer and you've got happy customers who come back again and again and again because they really value what you do for them, then a number of things, the shareholder outcomes are a manifestation of that. And so for us, yes, we're investors and we want that win-win, but we've got to have happy customers who come back. And that first principles thinking is where we start everything. So it is really fundamental to what we do. And yes, one of the very first conversations, Bertie and I were reminiscing about this just recently. Very first conversations the two of us ever had was trying to define quality. What does quality actually mean? And the answer is the best businesses, I don't care what geography or what sector, they always do something special for their customer. And as a consequence of that, you can see high returns on capital or great customer outcomes, etc., or great free cash flow. But it's all an outcome of helping your customer achieve their goals. So it is a really important part of how we think about investing and the philosophy. And the other bit, the last bit, of course, is valuation. We're very, very valuation sensitive. We have very high hurdles. I said before, what's the mission? The mission in Global Leaders, the mission is annual double-digit absolute IRRs. If we deliver that over 5-year periods, we know that beats the benchmark over time. And all of our underwriting writes to those double-digit IRRs. And that means that we have a very high cost of capital. And that's okay, because we're being very selective. But if we can do that, then we know that those great outcomes will come. So I think it's incredibly important to how we think is that starting at the top, which is that most important person in any business is the customer.
Maybe we can bring that a little to life with some examples, like how in the universe, or where in the universe do you find those business characteristics you've been speaking about in terms of the quality you're looking for? Maybe Bertie, you can take that one.
Yeah, absolutely. So, we spend a lot of time looking for investments across the world. a lot of travel, and continually pushing ourselves on our understanding of these individual business models. And one of the challenges as you get older and you do this job for longer is you continually making sure that you have updated views of these companies, because everything changes over time. Companies get stronger, they get weaker, their moats expand. But some areas that we have found the investments that have the characteristics that Mick just touched on would be financial market infrastructure, so exchanges and anything evolved around the decision making around making a financial decision. So there's going to be data businesses as well. Companies whereby they generate a significant amount of their revenue from the aftermarket, classic razor blade business models. We don't like them when they're taking advantage of your customers, Mick was mentioning, so they have to have a strong consumer surplus around them. But those can be very powerful because you're essentially building an installed base, a repeat custom, which means that you have a very strong underlying cash flow stream attached to it. Software is an area, specifically vertical market software, but you also in Microsoft as well. And I think what's really fascinating is, if you think about the explosion in data over the last decade and now the growth in AI, cloud infrastructure businesses are also very attractive to us. We feel that in some ways these are unregulated global utilities. And increasingly their position is going to keep compounding going forward. And we own Alphabet and Microsoft. I would say all these businesses, as Mick touched on, generate a significant amount of value for their customers, which allows them to push through price if they need to, if they're feeling inflationary pressure, but also their businesses or their compounding engines are protected by a selection of economic moats. And what we're really focused on when we do our first pass on the company is to making sure that our companies are not going to be subject to excess competition because they have features around their business model that means that they're fade resistant, essentially that they can keep compounding their cash flows for many years into the future if they keep satisfying their customers. So, moat is also a key part of our analysis, and all of these companies here we feel have very strong and expanding economic moats.
Thank you very much. I want to shift a little bit to not shifting really, but the investment philosophy and obviously the process that you've built on top of that has led to very strong annualized US dollar returns. You very well hit the target of double-digit IRRs and above the benchmark. But looking ahead, the question is obviously, how do you think you can sustain that performance and the alpha that you can generate going forward?
Yeah, this is a really important question. I'll start on this one, which is, and we didn't really get into this, but one of the ways that we think about adding value is we need to add value in more than one way. So this is one representation of performance, and I'll get into that in a second. But the other is what you just said, which is there's finding the great companies, there's investment selection, and that's incredibly important. And then there's the portfolio manager's job, which Bertie and I always talk about. That's buying, selling, sizing, right? That's allocating capital and getting big NAV behind the big winners. And when you have losers, and we all do, trying to minimize the losses. And so if we dig into the alpha, let's dig into the way that's on the screen here, which is incredibly important. The gross alpha, this is gross before any fees, has been about 300 basis points a year for the 10 years. So compounding, as we said, at double digits. And you can split that geographically as you've got here, where but just over 40% comes from companies in the US and just under 60% is internationally. I'm sure everybody knows that the US market has really outperformed over that period of time. And frankly, has gone from something like 50% in a global benchmark to more like 65% at the back end of last year. So that alpha has been very much driven in a very interesting way. It's not just being overweight the US, which is very easy, well, would have been an easy way to have outperformed over the 10 years. But also, this isn't about a lack of great companies in the US. This is about Bertie's and my definition and perception of value and where the team can find the IRRs. And so we're clearly very different to the benchmark. We've clearly generated the alpha in a very different way, be it through financials, as Bertie was talking about before, or other sectors. But there's a couple of other bits that are important here. We have very, very high active share. As Bertie said, we've got two strategies, both strategies, incredibly high active share, very, very low factor risk, very high idiosyncratic stock specific risk. In other words, all of that bottom up work that the analysts are doing is being reflected in the portfolios. And then as an example here, when you do it geographically, it comes out that the allocation to geos has been only about 10%. 90% of the alpha has actually come from the stock selection, which is incredibly important. That's our job, is go and find great companies and then allocate the capital behind them. And actually, if I keep going down that route, if we split it a different way, and you think about it as, okay, so we've got two processes. One is investment selection. Let's go and find these great companies. If you just equal weighted the strategy over time, that would have delivered about a third, so 100 basis points of that 300 gross. But the other 200 has come from capital allocation. And this is where Bertie and I sit down every week and we have a capital allocation meeting and we look through and we sit there and look at the IRRs and say, okay, hang on, the IRR's gone up because this share price has gone down. Should we be buying more and reallocating the capital in the strategy? And that's been very important for the two of us over time, because we can see, Bertie said before about working with the coach, we can see that we've improved over time on those buying, selling, sizing skills. And to me, that's probably the more interesting way to think about it in terms of that adding alpha in that way. There are two other ways though. The first one is this is a really good way. I'll just say one other one, which is downside protection. It's very important to protect the capital. And Bertie touched on before about moats, etc. The reason we want moats is to protect the downside. Because that is how we protect the capital over time, thinking back to that absolute return mentality. But Suzanne, you're spot on. This is a very, very good chart to think about protecting downside in a different way, which is this is the 10 biggest winners and the 10 worst losers that we've had this is just global leaders. And in this, you can see that the bigger active weights have driven the bigger impact into the portfolio. So it's not perfect, obviously, but there's an upward sloping line of the bigger the weights, the bigger the impact has been into the portfolio. So that big NAV behind the big winners. But also the contrary to that is, of course, we've had losers, but none of the losers have been more than 100 basis points. In other words, we've been through part of our process, which is the drawdown review. We've been managing to cap that downside. And maybe I should just talk for 1 second on the drawdown review, which is part of our rules and our capital allocation process is when we have losers, we have to deal with them. There's no point pretending this isn't happening. And one of our rules is if something's fallen 20%, we have to act. It's either a 20% off sale, bargain moment, let's go shopping and buy more, or we're wrong. We've made a mistake and we don't run at 100% hit rate. So let's cap those losses now. And you can see that when we're in the foxhole, when we're down 20% and either the market's trying to tell us something or something isn't correct, more often than not, for roughly 3/4 of the time when we buy, within 6 months they're dollar flat. In other words, whatever that issue was temporary. We didn't even care about it in 6 months' time. But also the contrary is when we sell, about 3/4 of the time they go on to materially underperform. And so in other words, this is where behavioral economics comes into action. And this is also part of the reason we split the process in two. The investment selection is to find great companies, and it's all about duration. It's all about time and thinking long term. But the capital allocation is all about using behavioral economics in action to drive alpha in the portfolio. And here's a really good example of it, which is we've moved the odds from 50-50 when we're buying something that's down 20% to it almost doesn't matter what we do. 3/4 of the time when we buy it works, and 3/4 of the time when we sell it works. But the most critical point is it changes the psychology, because instead of this being a crisis and a problem, and I'm down 20%, there's a mistake. The answer is it doesn't matter how we got here, but we are going to make a big decision, and we normally, not always, but normally make good decisions when we're in this situation. And so let's just go and make a good decision today. And having the data and working with the coach is what really drives that. Bertie, maybe I should hand over to Bertie. Is there anything you would add on there, Bertie?
Yeah, I mean, it's a really interesting question. We're just laser focused on investment excellence. And I think one of the benefits that we have is that we have a philosophy. We have a belief system that hasn't changed. But we also buy into this Ray Dalio idea that in many ways we're process engineers. That is, the two processes, we can always optimize them like a good engineer to get better outcomes over time. And what's been great over the last decade is that we've continued to fine-tune our processes, both the investment selection and capital allocation that you mentioned. We're using tools such as the drawdown review rule to help us get better, and that's been a really important part of our evolution. You know, our processes are iterative; they will continually be optimized. The way that we work and what we're looking for won't change, but we can always get better in everything that we do. And some of the, really sort of pivotal events throughout the year that have been really helpful for us to think about that improvement have been Think Week. So we have a week in the summer, which is a week of thinking time. It's not work time or family time. It's thinking very deeply about how we can get better and how we can improve. And the other pivotal moment that we have throughout the year is our offsite. So we have an offsite every year, normally in September. This year it's in America. Last year it was in the UK. And what we do there is we pull apart both of those processes, investment selection and capital allocation. And ground zero for us really is, how do we improve? How do we get better? How do we continually iterate to drive better outcomes? How do we add facets to our process, which means that we'll generate more alpha? And do we need to take things away? And I think what's really important, even though we're 10 years in, is that we maintain a day one mindset. We need to continually remind ourselves that we can always get better, we can always improve. And what we want to avoid is a day two mindset. A day two mindset, it really is when the process becomes the thing. So, we are totally cognizant that, if we start doing something because we feel that a process tells us to do it, that's the wrong reason to do it. It's all about driving great returns through our investors, using tools and processes to make sure that you can deliver repeatable outcomes. And that's actually been, one of the funnest attributes and most pleasing attributes of the last decade, is this continuing to iterate and try and get better with our processes.
Great, thank you both. I'd like to now move into the last section of the webinar, and then we can also answer some questions from the audience. Could you speak a little bit about the biggest challenges that you faced in investing over the last 10 years? But clearly you have more experience than 10 years, so you can go as far back as you want to, and also kind of rank like the current market environment we're in today within those challenges that you've seen over time.
That is a fun question. So, as you said, Bertie and I have both been doing this over 20 years each. And do you know what? The one thing that we often come back to is how much expiring information, short-term information, that we're just not even going to care about in 14 weeks. Most quarterly results, quite frankly, don't matter. And by the way, if you're going to own these companies for 5 and 10 years, and over a third of Global Leaders has been there for 10 years, right? If you're going to, like from day one, if you're going to own them for that period of time, a quarter literally doesn't matter. And so for us, when we sit there, and this is the whole point, back to the two processes, this is the whole point of the investment selection process, is about time arbitrage. It's about being able to invest on a 5-year view and take a differential view on time with the full confidence that our clients know that, they support us to do that's what Bertie and I, that's how we think, that's what we want to do with the team. It's how Brown thinks. So we've got back to Bertie's point on the institutional alpha. That alignment is incredibly important to be able to abstract yourself from that short term, whatever the worry is, and sit there. And one of our favorite questions is, do I care about this issue in 5 years' time? That question is foundational for us in terms of getting differential views on how we can find these IRRs in the market. So it's a really important part of how we think. And the other thing, just to be very specific on the current market environment, is that volatility for us is the opportunity normally. And it's so easy to say, but honestly, it's very hard to do, because when you're in the middle of COVID's my favorite example here, but we've done it again very recently. In COVID, when, literally for the two of us, we're locked in our basements, we don't know what's going on. I've got kids running around pretending to do homeschooling, which was an oxymoron in the Dillon household. And in that moment, we managed with the team to buy 3 new companies in the space of just over 2 weeks, in the last week of March and the first week of April 2020. And all 3 of those companies went on to deliver significant alpha in the strategy. And that's what I mean by volatility is the opportunity, whereby you abstract yourself from the presence and sit there and say, yeah, but what does this look like in 5 years' time? Do I have confidence and can I commit? And to get to the very recent, we've done it again after tariffs hit, which were, I'll be straight up, much worse than we anticipated when it came out on Liberation Day. And then we saw the markets go down and over the weekend and then really crack into that Monday, Tuesday. We started buying our first new investment this year at what we thought was a bargain moment. And so that you can't predict the volatility. This is one of Bertie's quotes. I'm totally stealing your line, Bertie. You can't predict the volatility, but you can use it as an opportunity. And that's where the drawdown review is important. That's where the ready to buy list is important. That's where the process is. That's when the rubber hits the road is, can you execute your process in those moments? So for us, I'm not going to pretend that it's fun, but in those moments, but do I get excited, exhilarated in those moments? Yeah, absolutely. Because that's when the game is truly on. And that's when you can make a difference for your investors in the long run. So it's something, yeah, like I said, I wouldn't claim that we look forward to extreme volatility, but definitely is it something whereby that is where the processes help us act in those moments of uncertainty? Absolutely. And it's a critical part to what we do and how we work together. Bertie, anything else you'd say there?
No, I think that's it. I mean, most investors are becoming, and most market participants are becoming increasingly short-term focused, which should give us a huge amount of opportunity. But with that comes, as you were describing, Mick, a huge amount of expiring information that's like the investing equivalent of buying a pint of milk. It's going to go off in a week's time. Trying to sift through that in an efficient manner and not getting distracted is an evergreen challenge for us, but I think it's one that we continue to work on. And I think a lot of the issues in the market with other investors is that they're thinking in sort of 1 or 2 years. They're not thinking in net present value terms.
Yeah.
And it's easy to forget that more than 85% of a company's value in net present value terms lies outside of year 1 and year 2 in the future. So that's where we're focusing. And that's, as you touched on earlier, Suzanne, time-based arbitrage is really one of our biggest sources of edge. And we need to remember that.
And now we're closing with a little secret from our internal morning meetings, our favorite questions. Ask every day, like, what's on your mind? But maybe a little bit more specific, not about the Dillon household, but like about the next 10 years or the next 20 years for global leaders.
Well, thank God the kids are back in school. Do you know what it is? And this is something that over time we've really come to focus in on, which is, what is our mission? Our mission is to deliver double-digit IRRs for our investors in global leaders and mid-teens in global focus. And that's what we underwrite to, and that is the job. And if we do our job, we'll deliver a great outcome for our investors. So I think Bertie said something before that's incredibly important. You can never sit still. You've always got to be thinking about, how can I be a better investor tomorrow than I am today? Like, what's that? Dave Brailsford talks about marginal gains in sport. It's the same thing for us as well. And so I'll be honest, what's on my mind is always like, where are we going to add value? Like, where can we improve? Where can we get better? What's the thing that we're not doing that we should be doing? What's the thing that we are doing that we should get rid of? And so that constant iteration and improvement is always on our mind with the goal of delivering the double-digit IRRs.
Bertie, any?
Yeah, I mean, for me, that what's on my mind is compounding. I mean, I think all the best things in life come from compounding. We passionately believe that's not just compounding cash flows and hopefully share prices, but that's also compounding your understanding of industries, your understanding of business models. And as we talked about earlier, you're compounding your processes as well, making small adjustments that you think will drive repeatable outcomes over time. And then also the other important point to mention, it's also compounding our relationships with many of our partners that are joined on this call. And that's what I'm looking forward to for the next decade, and the decade after that and the decade after that, is just continuing to compounding in everything that we do, hopefully compounding the company's cash flows and therefore the returns, but also compounding our knowledge, our understanding, our processes, and developing our relationships and spending time with our partners. It's been a complete pleasure to work with some amazing partners, and I always look forward to the conversations and looking forward to more of those as well.
A compounding relationship is a great way into questions. We have quite a number of questions on the team, but mainly on capital allocation. But maybe let's start with the compounding of a relationship questions. So there's one question about why the co-PM structure, like what is the benefits that you see, and also like kind of more generally, like how did the two of you get matched to start this journey at Brown?
John, I'll start. I think the co-PM structure is one of the defining differences that helps the two of us get better. I said right at the start, we hold each other to high standards, not just us across the team. We have process discipline. And by working with somebody else, by having that teammate, that partner in crime, do you know what? I often think we're on a quest like the Wright brothers, right? They're out there trying to learn how to fly. And for us, it's the same quest. And you're in it. That's that band of brothers. It's Jason and the Argonauts. However you want to think about it, is that everybody's got strengths and everybody's got weaknesses. And if you've got somebody who can help you with your weaknesses and help amplify your strengths, it makes all the difference. And it also brings that equanimity to be able to think long term, because in the moments when you're struggling, the other one's there to help. So I think it's an incredibly important part of how we do it, and that just everything we do is equals, and we're in it together. I think it's an incredibly important part. Bertie, what would you say?
Yeah, no, I wholeheartedly agree. I mean, the other point to mention is that it can be very lonely being a portfolio manager. You know, you're living with your decision making every day, every week, every year. And I think it's incredibly helpful to have someone that you can bounce those ideas off, but do it most importantly in an environment where you have psychological safety. And that's something that we've worked on over, the last decade, is to make sure that we're working together in an environment whereby you can express your hopes, dreams, and fears about different investments and trajectory of the team and everything else in a way that's non-threatening and non-judgmental. You know, unfortunately, there's a lot of ego in our industry. There's a lot of politics, a lot of bureaucracy. We don't have any of that. You know, I can walk into Mick's office and tell him I'm, incredibly worried about a certain business, and he's not going to judge me for that because he might have a different perspective. And I think that's something that is very, very refreshing. It's not about who's right and wrong. It's about how do we get to the right decision for the benefit of our partners. In terms of how we met, which I think was also part of your question, Suzanne, we hadn't met before, but we were put together by Logie Fitzwilliams, who was the head of international business and is now the CEO of Brown Advisory. And we got on like a house on fire when we first met, really thinking about long-term investing, but also, as Mick touched on earlier, defining quality numerically. It's not this nebulous concept, it's something we have to see in the numbers. And then also embedding the behavioral side of investing into how you're working as well. And then also, as I kind of touched on earlier, this continuous improvement part of what we do. So there's all the areas that sort of Mick and I hit it off when we first met. But over sort of many dinners and drinks and lunches, etc. It was pretty clear to me that we had a very solid foundation for compounding.
Right. On the behavioral, maybe just a couple of words with questions around, what does the behavioral coach do? Who is it in terms of, internal, external? So maybe you can give a little bit of a background of the years we've been working with an external coach and how that has impacted your decision making around behavioral biases.
Yeah, I'll have a quick crack at this one actually, if that's okay. Which is, we use the word coach very specifically because this is not just a quantitative exercise we go through every single decision that we make, and we sit down with the coach every quarter and we're looking for ways to get better, or either things we're doing wrong and so you want to minimize the errors, or ways to get better. And we started off actually doing it internally, and we could do the analysis internally, but what we were missing was that coaching role. That think of it like professional sport, where the best teams have a coach whose job is to help them get better. And Bertie touched on this before about humility. It takes a ton of humility because we sit down every quarter going in thinking, okay, there's a way I can get better, and that's exciting, but that means I must have done something wrong, and that's not brilliant. And so that constant improvement mentality of working with the coach. Don't forget, we're making decisions under uncertainty with incomplete information in a complex adaptive system, right? That is very similar again to professional sport where you don't have a pass completion rate of 100%. If you do, you're probably not trying hard enough. And so for the two of us, this is why it's really a coaching role, because a lot of it comes down to behavioral economics. It's about regret aversion or loss aversion, which we touched on before, or all of these behavioral economics concepts that we see in the literature. So I think I'll be really honest, it's probably the best thing I've ever done as a fund manager. It takes a ton of self introspection. But then again, this is back to the being in a partnership with Bertie. The two of us are on the journey together. And so it's our goal to help each other. So, Bertie, what else would you say there?
No, I think you covered it. I think part of your question, or part of the reader's questions or the viewer's question, was who is it? Unfortunately, we don't disclose who it is because we do see them as a source of edge. Certainly, unless you become a sort of one of our LPs, we generally don't disclose who they are. But yeah, as you mentioned, Mick, it's been very, very powerful. But it is humiliating as well, because when you're presented with information you don't like, the amygdala in your brain goes into fight or flight. And I think it's been one of the most important parts of our compounding as investors over the last decade.
Bertie, I remember you used to call it reverse therapy.
Yeah, absolutely.
Okay, I kept a big one for the end, but we have a good 5 minutes, depending on how you want to answer it. It's about capital allocation, really. If you can speak more about it, and also like the two kind of different questions related to it. So first, speak more about capital allocation, if you can. How do you deal with also underperformers that are not necessarily addressed by the drawdown review? And how do you measure that positive impact of capital allocation? And then we close for today.
I've been starting a heap of.
Yeah, sure, absolutely. So, kind of as Mick touched on earlier, I think it's really important that you have two processes. Investment selection is about finding the right companies, and that's where most investors focus their energies. But capital allocation is something that you don't get any training on. When you do your CFA MBA classes, you get taught how to build a DCF. No one tells you how to allocate capital. And the way that we think about it, and Mick touched on this earlier, is are you adding value through your hit rate, so winners versus losers, but then also your slugging percentage, which is the amount of NAV you have in your winners versus your losers. And as Mick touched on earlier, it's really gratifying to see that over the last decade we've added value through both, but increasingly more through capital allocation. So I guess, how does our capital allocation approach work? Mick and I have a separate meeting every week. We have a capital allocation pack that gets produced for us. And what we're really looking to do at a high level is to move capital away from companies whereby the IRR, so our expectation of future alpha, has come down, and recycle that capital into companies where the IRR is more attractive, typically because the share price has underperformed and the cash flow stream has continued to compound. So the core of it is Mick and I sitting down and saying, look at X, Y, and Z company. It's experienced what we call IRR decay, because basically the share price growth has outstripped the cash flow stream growth. We'll have a conversation and say, should we take capital out of that company and should we put it into another company which typically is underperformed? And then we'll have a discussion with the analysts who are worried about anything. But normally the topping up and top slicing is based on IRR. And I think one of the most pleasing things is that the double-digit IRR that we write to in Global Leaders has been more than delivered when you look at the historical trailing alpha. So, sticky to this underwriting process, chopping up and top slicing, and then that also being reflected in the alpha generation between hit rate and slugging percentage has been good to see. Now, there are other facets of the capital allocation approach. We talked a second ago about some of the behavioral rules we developed in conjunction with the coach. You also asked about periodic underperformers or companies that maybe are a source of what we call the death by 1,000 cuts. So these can be small positions that aren't drawing down, but they don't generate alpha and they slowly degrade the alpha, or they sap alpha. Mick and I periodically do blank sheet of paper reviews. So what we'll do is we'll force rank the portfolio, we'll come back, we'll compare notes and ask ourselves, hey, there's X, Y, and Z company which hasn't drawn down, hasn't been a big source of alpha. Do we need to have a review? And then we'll go back to the analyst and look at it like that. And then the other check that we have as well is that the consultants that we work with, they will typically hold a mirror up to those underperformers. We've got a sort of slightly unglamorous term for it, but the middle layer of fat, as we call it, which is the middle positions that have generated no alpha. And the bias you're trying to overcome with this is the endowment effect. We have an unnatural attachment to items that are in our possession. And I think it's really important as investors that you shine a light on those companies. They might be fine companies, but if they're slowly detracting from alpha and they're not the best use of capital, that's also helpful. The last point to mention on the capital allocation process is we also do look at the factor analysis, and Mick was kind of alluding to this earlier. It's very easy for us to sleepwalk into unwanted country and currency exposure. Yes, a factor, a model makes a number of assumptions that we don't agree with, but it is very, very helpful as a sense check. So you need to know where you're taking country and currency risks, because a danger that we would face is we do all this great work and suddenly, macro factors, so, dollar yen exchange rate or US interest rates, or, being underweight the US or being underweight Japan is having a much bigger drive in our returns than our investments. So, that's the last sort of facet or last input for the capital allocation approach. But, like everything we've talked about, it's all iterative. We always think that we can improve both as investment selectors, as finding the right companies, but also as capital allocators. So when we think about the next decade, I'm sure there are going to be more attributes of allocation approach, always to drive better outcomes. So yeah, it's been fun working on that side of our process as well as the investment selection side over the last decade.
The one thing, the part of the question was how do you calculate it? So I'll just address that bit, which is the way that we do it is we literally sit there and equate the portfolio. Anytime something comes in or out, equate it and just let it run. And that, we're trying to get a pure investment selection, or people call it stock picking. We really don't like that term. We're investors. But if you do that, if we go back just to put some numbers on this, the average annual hit rate in the strategy is at 55%, and so above 50, so clearly adding value, and that's very important because you can just equate the portfolio, therefore, and outperform. To Bertie's point, well, we better be doing something above that, or frankly, fire the two of us and just hire the analysts, right? And so that's where you're differentiating between the analyst skill and the PM skill. And the other thing to think about on that 55 hit rate since inception is, don't forget, even just the last 2 years, 7 out of 10 companies in MSCI ACWI have underperformed. And if you look at it over the 2 years, less than 1 in 4 companies over the last 2 years has actually outperformed the benchmark. So the analysts are doing a phenomenal job to be driving a 55 hit rate in this strategy. And that is incredibly important, back to the processes of there's more than one way that you can be driving and aiming at these marginal gains and the improvements over time. One really important thing that we do in capital allocation that we don't really talk about a lot, we've both touched on it, but we haven't gotten into it, is thinking not just about what's the upside, but what's the probability of that upside. And if it goes wrong, how badly does it go wrong? And what's my chances? Is it a 1 in 4 chance that I get that downside, or is it 50-50 that I might lose money in this investment? And that calibration is an exercise that we do. So for every investment we do, we're thinking about, well, what's the probability of this? What's the asymmetry of the returns? What does it look like, to Bertie's point, compared to everything else? And what do the IRRs look like basically in the portfolio, both from a base case, what are we playing for, but also what's the expected return when I probability adjust this, and how can it go? And one of the things we did at the offsite a couple of years back was we went back and we looked through with analysis from the coach, the probability buckets of, when we say 75% chance, which is the maximum we put on anything, 3 and 4 chance we'll get our base case. So we're a long way away from 50-50 on this. What does it run at? And the answer is it runs at over 90%. So in other words, it's important to understand that this measurement, the fine-tuned measurement within the process, is incredibly important, because that's, again, where we get these marginal gains. So that calibration, and then thinking about the risk and the downside, it's not about the upside. If we underwrite correctly, we'll get the base cases. The issue is when we're wrong. And that mentality of inverting it from I'm going for something rather than I'm protecting something, for us, is really important, a part of the capital allocation, because it gets reflected in the position sizings when we're thinking there on the capital allocation. So I hope I've answered the question on the calibration and then thinking a bit about
Great. Perfect. Thank you, Mick, and thank you, Bertie. I think we answered really most of the questions, and we will definitely try to reach out to everyone. We've not been able to address the question today, but we're right on time. So thank you very much, Mick. Thank you very much, Bertie. We really appreciate your time today, but obviously for everyone who listened and participated, thank you so much, and thank you for being invested in Global Leaders. Have a good day, everyone.